welcome and thank you for being here this afternoon. My name is Tracy George. I'm the events coordinator here at Hispan, and I am pleased to introduce Meaghan Dowd, our Director of Product Insurance. She has four specific destinations, each related to specialized knowledge in different areas of insurance and wealth management. What we're talking about here today is Underwriting Uncovered, what advisors need to know about PNC risk decisions. Before we dive in, yes, this webinar will be recorded. Yes, the slides will be sent out afterwards. And please direct any questions into the Q&A, and we'll do our best to answer them as we go. Also, within the lobby or the resources tab below, you can access a couple of resources already available to you ahead of time, but we will still send out the slides, the recording, and any other materials via email to all who registered after the webinar. Also, this webinar is eligible for one CFPC credit, but you do need to be here live for the full session to get credit. And with that, Meaghan, I'd love to hand it over to you.
Thank you so much, Tracy, and thank you all for attending today. As Tracy mentioned, we're going to discuss underwriting specifically around property and casualty insurance. So insurability is the new credit score. And what I mean by that is if clients are not insurable, that can keep them from owning homes, owning vehicles, especially when there's loans. A lot of times mortgages, vehicle loans all require insurance to kind of cover the collateral in which they're lending you on. And so, from an advisor perspective, knowing the key PNC underwriting factors really is going to help you anticipate risk, prevent surprises, and advocate for better outcomes for your clients. So, why do advisors need to understand PNC underwriting? So, there's a few people that are part of this process, and underwriting really isn't a hurdle. It's a mirror that reflects your client's risk reality. So when you can understand it, you can explain it, and what once felt like a black box turns into the strategic advantage for you and your client. So there might feel like there's a blur between agent and underwriters, but their responsibilities are pretty distinct. From the underwriter's perspective, they're really here to help from inside the company. They review the data, they evaluate the risk, and they decide whether the company wants that exposure or not. The agent or broker is really focused more on gathering the details and advocating for the best fit, and is the one working the front lines with the client specifically. And then there's you, the financial advisor, where you really aren't submitting the applications, but you can help flag issues early and help set realistic expectations for your clients and really make sure both sides communicate properly during this process. So when we talk about the advisors, we're really wanting them to kind of picture yourselves as a risk navigator. And this is where you end tremendous value because clients rarely understand why they feel so overwhelmed by insurance. A lot of times they feel like the questions are invasive, but you can explain the plain language and really help them understand that they're not trying to dig too deep. These are questions that insurance professionals need to know, and so when you coordinate with the insurance professional, you just really help those go smoother. You, again, can help coordinate and then for certain situations, escalate to that expert. And this is really where having a trusted risk manager is your fiduciary responsibility. And obviously collaborating with them to kind of set yourself apart from being just an asset manager, but more of that risk manager. So advisors who understand underwriting don't replace agents, you empower your clients. And I think that's one of, the biggest things is clients trust you all a lot. They don't trust insurance professionals. They don't understand why they need to know their net worth or all of these, again, invasive questions. But you as the advisor can help them understand that by disclosing this, it makes sure the insurance fits them appropriately and again, empowers them to purchase the right coverage. So when we talk about underwriting, risk management, and again, that's the role I feel advisors play in the PNC puzzle. It starts with what you don't see. So PNC really protects that foundation of the financial plan. It again, really illuminates that quarterback position that clients expect you all to play with spotting the potential issues. And, as we walk through risk management and practice, we often delegate PNC to insurance agents. But the clients don't always see those boundaries. So that's where you, again, become that trusted individual to help navigate those. And then you help understand underwriting red flags. So from that perspective, understanding the what and why behind insurance and why it might be harder to insure a Lamborghini that your clients just purchased, but they've never drove anything besides a Honda. Or when they go to buy that really big boat that they've, again, never had before, you can help prepare them for the difficulties and level set those expectations. And or maybe your clients have had a lot of accidents. Knowing that the market's going to be harder, or again, obtaining certain coverages based on those different underwriting flags that we'll discuss in further detail is where you really position yourself and help support this underwriting process. And like everything, underwriting is really a data-driven assessment of the risk. So, when we talk about insurance, it's important to understand how reinsurance works because behind every insurance company, there is that extra layer. And when reinsurance raises their prices, insurance has to pass that cost down to policyholders. So, this is one reason we're seeing capacity shortages. Even well run insurance companies have less room to take on new clients. So, we're just going to kind of walk through the process real quickly. First, we have the customer. When you think about the customer, they really want to reduce their financial uncertainty, whether that's property or health. They're aware that they may face property damages or health issues or something else, whether it's, again, an auto accident. And the way that we've learned to kind of transfer that risk is go to an insurance company and buy an insurance policy. And by buying that insurance policy, the customer's transferring their risk to the insurance and really exchange for paying a monthly or yearly premium. And in return, the client assumes they have financial protection if something bad happens, and really the support of the insurance company. If you sat in some of our other webinars, that does vary based on the company and a lot of other aspects at time of a claim. But this is, again, the general idea from the customer's perspective of what's happening. So then from the insurer, we're really looking at they are the ones collecting the premiums. They make sure the insurance company has enough money to pay the claims. And then they reduce their risk by buying reinsurance and, again, kind of ceding that part of the risk. So, why we need reinsurance is to gain financial protection for large unexpected claims. It helps strengthen the ability to pay customers at once. The role of reinsurance is really to provide that financial protection, help insurance stay solvent, and receive reinsurance premiums. And then what we do with them is invest the premiums to generate returns and ensure liquidity to pay large claims. So again, the insurance, when you pay or your clients pay premiums, it doesn't just stop at that insurance company. There is a flow that happens. So from there, there's the investments of premium. By either the reinsurer or insurer. And the goal, just like with you all and clients' money, is to maximize the returns while making sure funds are available at time of claim. And this obviously has a bunch of different purposes, whether it's to pay dividends, maintain sufficiency during claims, just achieve general profitability. If you sat, again, in another webinar, we talked about how a lot of insurance companies actually run over 100% loss ratio, and they're able to do that because of the investment of premiums in the market. So when we talk about the risk, it's really, there's a few ways that the money flows. So one is from the customer to the insurer. Then we have the insurer to the reinsurer, and then we have the reinsurer to the asset management. So again, just showing you these dollars work in different ways and allow the insurance company to stay profitable, even if underwriting and the steps we're going to go through here in the next few slides is not as profitable as desired. So really the system works for a few reasons. First is going to be that the customer reduces their financial risk. So at the end of the day, the end consumer, if their house burns down, they have a really large auto accident, the monthly premium or that yearly premium they paid usually tends to offset it. Now, where this becomes frustration is when the client has a smaller, I'm going to say smaller claim, like a $5,000 water backup. And while they think that's what insurance is for, it may not, again, reduce that financial risk as much as they had hoped. We then have it to, again, help reduce the larger loss through that the insurer may experience. The reinsurers then invest the funds to stay financially strong and profitable, and it really just allows the entire ecosystem to stay stable and protect all parties involved. So inside the underwriting process, First, it's important to understand what is underwriting in PNC. And as you'll notice under this image, it's really the bridge between risk exposure and insurance pricing, and it turns risk into a price tag. So the definition is pretty simple. It's just the process of assessing risk to determine whether to offer coverage and at what price. And really, this is to ensure that premiums match the actual level of risk, so insurers remain solvent. So underwriting is how insurers decide who to insure, how much to charge, and what coverage really applies. And it's a balancing act between what the company, needs enough, but also they don't want to chase away the good clients by having the cost be too expensive. So obviously we'll talk through what those different characteristics are, but essentially underwriting turns uncertainty into a measurable price. It's the math and judgment behind every premium. So it's a few step process. First, we have the application intake. Then we're going to have the data gathering, some risk evolution, or excuse me, evaluation, pricing and coverage recommendations, and approval or declination. So it starts with the application, and that's really the snapshot of what the client has going on. Then, when we're talking about the data gathering, it's where the underwriters validate, and usually there's supplements needed during this process, especially for unique risk. They then evaluate the risk, price it appropriately, and recommend coverages. And what looks like a simple submission, as you'll learn in these next 5 slides, really has some complexity, whether that's a human doing it or technology at this point. So, first is our intake application. And underwriting starts with the information provided. And this is where a lot of problems actually arise. Missing details, inconsistencies, unchecked boxes that can send the application back and forth, such as is there a dog in the household? When was the roof last updated? And as an advisor, your role is to ensure that the story makes sense. Assets match coverage, ownership structures are clear, and nothing critical is left out. It's the insurance equivalent to a clean financial plan input. So, again, while this seems like an easy step, what a lot of clients do on their phones late at night, this information matters. And if your clients aren't answering some of these deeper questions, like are there animals in household? When was the last time their wiring or roofing was updated? Do they travel outside the US? Can really potentially mean that there's some gaps that will arise after the policy is placed. So, the next step in the process is the data gathering. And once the application's in, the underwriter starts pulling data from a wide range of sources. They look to the public databases, they verify prior losses through Clue report. So that's how they look at prior home losses as well as property for auto. And then we have an MVR on the auto side of things, which is looking up moving violations. And sometimes they order inspections or do drone imagery. So I've had a lot of clients who we can't even get through the quoting stage in the past because the insurance company has, again, that aerial view over the house where there's trees overhanging. And so they're not even offering quotes because of what they're finding online. So, one thing many clients don't realize is the insurance score also has a big impact on the different pricing that they'll pay and sometimes even the eligibility that they have within the marketplace. So once they do the data gathering, then they're going to evaluate the risk. And when they're evaluating the risk, this is really where art and science meet. The underwriter synthesizes all the data, the property age, the condition, the usage, prior losses, and they think of it like an investment analysis. They're asking, does the does the return premium justify the exposure, which is the risk? Frequent small claims or deferred maintenance can be big red flags. An advisor who catches these early can help set the right expectations for clients. So, again, we hear a lot on the news about fires or earthquakes, especially those larger ones that are, more devastating or catastrophic to larger areas. But all of these play different roles in where and how they are acceptable within the marketplace. So I would say the condition is a big one that a lot of people don't know the last time their electric was updated. They don't know if they have knob and tube wiring or if they have galvanized plumbing. But all of those things can actually be underwriting not only questions, but eligibility issues to where if they're not disclosed during this risk evaluation, they can end up making coverage void based on them actually being in the household. So next we come to our pricing and coverages. And just so I don't forget this thought, really what I will say is the information your clients provide to underwriting is as good as the policy is going to be. If they are not clear during the underwriting process, everything they have going on, that's where we tend to find those exclusions or gaps really start to arise when clients want to provide as little as possible so they can get the best pricing, as you'll see in step 4. But what it ends up doing is not transferring all the risk that they actually have going on in their life to the appropriate insurance company and potentially paying higher pricing, but getting the right coverages for that cost. So when we talk about pricing and coverages, this is where risk and the pricing really starts to flow. If clients' homes, again, have the outdated wiring, the carrier might offer coverage, but then they're going to have potentially a higher deductible, or they may give your client 60 or 90 days to update that wiring. I've had clients in the past, again, buying a home that they absolutely loved, but it had that knob and tube wiring. And while it may be $30,000 to update a small portion of the home, some insurance companies with a signed contract from a contractor will bind coverage for again, 60 days in Missouri sometimes. And then again, if they don't get proof of updated wiring, they will send out a cancellation notice after that coverage has been bound. So this is where sometimes those underwriting requirements do again bleed into the policy period and can seem like the client has coverage, but then quickly 60 days later turn into a fire if the right expectations aren't set up front about, again, what this pricing and coverage really means. And again, the advisor's role here is to help the clients balance affordability with their comfort level and risk tolerance. So after pricing and coverage recommendations have been made, there's then the approval or declination process. So this is where an applicant, again, is approved or declined. If they are approved, it could still come with reduced limits or higher deductibles or specific requirements, like I discussed in the previous slide. But when it's declined, it doesn't always mean it's declined across the market. So different insurance companies have different appetites. So sometimes that declination could just be for that specific company. It could also just be for a specific time period. So maybe the client's gone through some unfortunate events where they've had 2 water losses in their home in the last 6 years. Over that 6 year period, there's not going to be a lot of insurance companies that might offer a rate, but after that 6 year period, you might start to again get some different options and approvals in the marketplace. So sometimes declinations are forever, sometimes they're just for a time period and or a situation dependent. So why do coverages get denied or kind of delays in the underwriting process? And even the smallest inconsistencies, like I mentioned earlier, the roof being newer than it is, but according to an assessor site that the underwriter has access to, the last permit was pulled in 2005, but the application says the roof was updated in 2019. They might need some type of documentation from your client to support that and or again get those quotes and rates out the door. Other things that will kind of delay or deny coverages are multiple small claims or maintenance issues typically will signal to underwriting that there's ongoing risk. And yes, like I mentioned earlier, the insurance score can even be a deal breaker. And helping clients maintain good financial habits, such as paying bills on time, managing claims wisely, and again, paying those smaller ones out of pocket can actually improve their insurability. So, how can advisors support the underwriting process? And really, the best thing you can do for your clients is set them up for success by making sure that their property info is accurate, upgrades are documented. So, again, as you start to plan with them to do those home renovations, make sure when they're getting the permits, you save them in a file that you have for them. So, if and when insurance underwriters come to the client and are like, when did you update your wiring? What type of wiring is in your house? If you have that information, you can quickly share it. That's also a great reason to keep your client's inspection on file when they purchase a home. A lot of times, those inspections will answer a lot of the questions that clients just don't know off the top of their head about their home. And again, easily being able to provide those documents can help speed up the underwriting process and even allow clients to qualify for coverages that they may otherwise assumed they're not. So again, encouraging clients to really think proactively, whether it's installing water shutoff valves or water sensors to again avoid claims. Like I mentioned earlier with the water issues, sometimes the coverage might be denied because there's been again those two water losses. But if your client installs a water shutoff valve and a water leak detection system, then maybe the insurance company will reconsider offering those rates, and now they can go with a premium insurance company, help avoid losses, and again even get some reduction in premium by being proactive in those risk mitigation devices. And obviously a clean underwriting file not only speeds up the approvals, but it can actually lead to better pricing and smoother renewals down the road. Again, you would be shocked at the cost difference from a roof that was replaced in 2015 and one that was replaced in 2020. It can usually be a couple $100s. And so just knowing that 5-year difference can again impact the overall cost for your clients. So, what are some of the emerging trends that we are seeing in underwriting? Obviously, we have the climate, trends that we continue to see. When we talk about insurance right now, we're in what we kind of call a hard market. That means insurance are tightening their standards, they're raising premiums, and in some cases, they're even pulling out of entire states. And the driver really is the raising catastrophe losses. There's more expensive repairs, higher reinsurance costs, like we discussed earlier, and the new data tools that pinpoint risk more precisely than ever. So again, back in the day, there's actual manual rating fold or like binders that each company would have. Now they use technology just like the rest of the world. And so while that technology can be helpful, it can also, again, really reinforce some risk that maybe a specific home, neighborhood, or demographic kind of experiences that, again, make this even a harder and pricier market than we've ever seen before. So when we talk about climate and catastrophe, climate is the biggest underwriting variable at this point. Losses aren't just big disasters like hurricanes, but they're secondary losses like hail or severe freezing. I'll show a map in the next slide, and I think a lot of you will be shocked at how much red is in the Midwest. A lot of times we think of catastrophic and climate really happening on coastal areas, but this is an issue we're experiencing all across the United States, and insurers are reacting by shrinking their exposure zones or capping the number of policies they entertain, even in a specific zip code. So, again, this is where a client can live next door to each other, but have different zip codes and have different eligibilities based on the actual zip code in which they're located. So, advisors can help prepare clients by discussing these risks before they move. So, as your clients start to look at new homes, talk with the insurance providers, tell them to work with them to understand, are these homes insurable, are we experiencing any uninsurability in the area, and really moving to more of a due diligence process when it comes to the actual insurability of homes. So, like I mentioned, this is kind of the catastrophe. So, where properties are most at risk, you can kind of see the different scaling. But again, no surprise down here, but this was a lot redder than I thought it would be. And then this is obviously where homeowners kind of pay the most based on the values. This, though, was a map that I found that really showcases the homes that are uninsured by state. So, again, correlates a little bit back to the cost, but also just showing homes are your client's largest assets. And so, if they are not insured at all, how much are we exposing if there is just a simple loss or a total loss? Why aren't we able to insure homes in this area? Is it due to market capacity? Is it due to clients just having the ability to insure themselves? But this is, again, just something that gets the brain going and thinking about how impactful underwriting really is and the effect it has in every state across the US. So, the next big thing that we think through, even if the home hasn't changed, there's inflation and claims costs. So, between supply chain issues, labor shortages, social inflation, that's meaning like bigger settlements for those liability claims, uh, we are seeing that really just drive up premiums and require coverage limits. So advisors again should just really make clients aware and help them review their coverages annually, especially replacement costs. So in 2020, we saw construction, obviously go up quite a bit. The cost to repair vehicles is going up. So I think this was an interesting stat around electric vehicles. So people assume that electric vehicles are cheaper to insure. That's not the case. And as you can see here, they actually take longer to repair and are more expensive. So as we get into this digital world, the world of electronic vehicles, this is only going to continue to impact the cost and the underwriting of the PNC world. So the next big thing that we're seeing is the transformation of data. So again, underwriters no longer solely rely on paper applications. They have AI-driven models that predict loss likelihoods with incredible preciseness. Telematics devices track for auto that also help get you that individualized pricing that everybody always says they want. Smart home sensors track leaks, temperatures, electrical shortages, and this data can help clients who manage risk well, but it also can be a little less forgiving in underwriting. And so those that don't manage risk well, advisors can help those clients understand these tools are available and really kind of part of the equation when we talk about risk. One of the most interesting things about this data and really telematics is, again, this can be just for one driver in the household. So maybe your clients have younger drivers and they don't want the rates to skyrocket. I've seen some insurance companies give discounts of 30% for that vehicle that the kid is driving when they don't hard brake, when they don't speed, if they don't drive between certain hours. So again, this can be a really good way to help clients get more of that individualized pricing and avoid claims from occurring, like we mentioned, with those risk mitigation and kind of smart sensors within the home. But this also opens up a whole nother rabbit hole of cyber issues that, again, really, from a consumer standpoint of the Internet of Things and how, sometimes having those technologies in the home just need a little bit safer maintenance and cyber hygiene. And again, this just really kind of adds more of that black box to insurance when it comes to declinations. And I can tell you from working in the insurance industry, a lot of times if it's declined based on the data that's pulled, it is really hard to get that declination reversed, especially in what we call like that middle market world of insurance where they're not using human underwriters anymore. They are doing like the instant rates and bindable quotes, but that also means that if there's a declination, there's very little room to kind of go back and understand why. So what does this mean for the advisor? In today's hard market, planning ahead is everything. Building in the extra time for policy reviews, gathering documents early, and helping clients understand underwriting decisions are market driven, not personal. I don't know how many times again clients have come to me and they're like, why are they declining me? Why are my prices going up? I didn't have any accidents. I didn't do anything to my home this year. Obviously, rate seems very personal to clients, but you can help realign them and helping them understand that again, it's very much data driven and usually has little to do within their control outside of a few factors we'll talk about here shortly. And again, just reinforcing that you will guide them through the increasing unpredictability of the environment in which PNC is currently in. And I think it's also important to maintain relationships with multiple insurance professionals. Even when I was in the industry, I would always tell advisors to have a few because one, we all have different contracts with different carriers. So very few insurance companies have the exact same ones. Also, different insurance agents think differently. So for depending on what your clients have going on, I used to work with a lot of clients that traveled or had equestrian exposure because that was one of the niches I worked in. I had other advisors that really focused on art and collectibles or watercrafts. And so if a client came to me that had, one of them had a yacht that they chartered, that really wasn't my expertise. So I told the advisor to work with a colleague of mine to get the advice that they really needed for that client. So again, understanding the niches you serve and then having insurance professionals that complement those niches really just make you look like the superhero you are, whether that's being proactive or in unfortunate situations reactive to client needs. So underwriting really is an extension of financial planning. It's the same way you assess the market risk or state exposures. Insurance assesses the physical and behavioral risk. So advisors who understand the why behind underwriting can really integrate it into wealth management. And when you can explain the connection to clients, you move from being an advisor to more of a trusted risk strategist, which again, we're really trying to move and help advisors see that the risk tolerance and what you know about your clients easily transfers into insurance and helping them get the most value and protection out of these programs. So, what are some common underwriting factors and what do they mean for your clients? And now that we understand how underwriting works, we're really going to jump into kind of what they actually look for. And there are factors that kind of drive every decision, whether it's a simple auto renewal or a multi-million dollar home policy. As you will see, many of the things advisors can help clients anticipate and manage. But insurance is not a one size fits all product. Every underwriting decision does stem from some type of risk factor, and the exact same data point can be viewed differently by insurance carriers. A perfect example is the insurance score. So, in some situations, if clients have a really good insurance score, that can get them better rates. With other markets, they don't weight heavily on the insurance score. So, even if your client has a really good insurance score, they might get the same rate as someone who has a less favorable insurance score, but the same driving record with like a progressive per se. So, again, sometimes understanding what companies rate on and give discounts for can also help clients that, again, do have those good risk habits pay the right pricing. So, when we talk about this word insurance score, this is a pretty big slide, so I'm not going to read through all of it, but I just really wanted to help illustrate that one, it's not the credit score, while credit score does weigh heavily in this. It really does also think through the payment history, links with other insurance companies, and why we use this in insurance is it really just helps understand the likelihood that someone's going to have a claim, the frequency of those claims, and potentially the severity. But what this means for your client is typically a higher insurance score means lower premiums, where a lower insurance score means higher premiums. So, again, this is where it trickles into paying more for things that they may not always have anticipated. It does impact underwriting decisions and it does kind of become a predictor of long term insurance costs. So, again, this is one of those things that clients do have in their control. And by maintaining a good insurance score, can hopefully pay better pricing and have more market options should they choose to shop. And advisors can really support this by maintaining good credit habits, understanding how the financial decisions affect their insurability, and then obviously planning for long-term credit health. So when we talk about properties, there are a few underwriting things that come to mind. So first is really the condition, the location, and kind of the behavior of that home. You know, a 1920s home is absolutely insurable, but if the wiring and plumbing have not been updated, like I discussed earlier, that's a major concern and something that can make that home uninsurable. So that's where maybe a home might be priced really, really competitively, but it's because they haven't updated some of those core value or core pieces of the home that make it insurable in the marketplace. Location is another big one. Insurers now use precise geocoding to assess risk down to which side of the street floods more. I've even seen this on, two homes in the same neighborhood can have different theft rates per se. And what I mean by that is if the home sits at the front of the street, they're going to pay slightly more for the theft exposure within the overall premium than a client that sits at the back of the street because most in the actuarial world, from what they found, most robbers are going to come to one of the first two homes because it's easier for them to get out and away after the crime occurs. Where again, if they're in the back of the neighborhood, especially if it's a single point in and out neighborhood, you're less likely to have a theft. And in that case, the theft rate on the homeowners uh, metrics are lower. Same thing with fire. If your clients sit at the front of the neighborhood closer to the fire hydrant, they may pay a slightly less fire rate than if they sit in the back of the neighborhood because it takes 10 seconds longer for the fire department to get there. So all of these little metrics now can have big impacts on what your clients pay. Are their homes insurable, and will they remain insurable throughout the long haul? And then the other thing that we see a lot with underwriting factors is the swapping of names. So this also applies in the auto world with insurance scores. And so what I mean by this is we'll have Professor Peter and Paula. And so Peter's insurance score and Paula's, some insurance companies, as long as they're both on the application, they'll just use the better of the insurance scores. Other insurance companies use the first named insured. So if Peter's insurance score is better than Paula's, we're going to want to put Peter first. If Paula's is better than Peter's, we'd want to put Paula's first. And this is something that, again, when you have a partnership with an insurance professional, they can help tell you what your client's insurance scores are, and just know that the insurance score with Safeco is different than the insurance score with Cincinnati, which is different than the insurance score with State Farm. So it's not like a credit score that is even within like a few points of each other. They can dramatically be different based on the insurance company and the rating systems that they use. So um, but again, the order in which the named insureds are can have an impact on the insurance score that the company is using to rate, and in which case, potentially have a negative or positive impact depending on who has the better insurance score. And then for the auto, underwriting is all about data consistency, who drives what, where the vehicles are kept, how they are used. So again, when your kids go off to college, it's important, or excuse me, clients' kids go off to college, it's important that they update the garaging location of those vehicles where the cars are going to be kept. Excuse me, or maybe kids aren't taking the vehicles away to college. Now we need to update the insurance or the underwriting to know that those are just occasional drivers, which will then give clients a credit on their overall, or a discount depending if they're over 100 miles away or not. So again, who drives the car, how they use it. So those kids that maybe use it for Uber or Uber Eats, if they're the drivers of those cars, there can be exclusions or limitations on insurance companies that are open to riding those. A luxury car is obviously going to have different underwriting factors, especially if you have those clients that want agreed value for those exotic vehicles like the Lamborghinis. Your standard auto company may not offer agreed value over $250,000, which for a lot of us on the phone is like, that's a really expensive car. But there's a lot of clients out there that do own cars that are $500,000. And so those factors all play into underwriting. A lot of times it's known as symbols. And so depending on the symbol of that vehicle can affect if it's eligible or not with an insurance company. And again, just helping clients keep this information accurate and consistent is extremely important, even down to the vehicle model. You all would be shocked how many clients don't know their vehicle models. And again, for 98% of your clients, not a big deal. But there are certain like Bentleys out there that the certain model type insurance companies won't write, but they'll write the other Bentley model type. So I have myself presented a quote that I thought it was the eligible Bentley, and it wasn't an eligible Bentley based on just a minor change in that type. So again, this is where the advisor can really help make sure that all the data that's being given to the insurance agent, that is then going to the underwriter to determine eligibility, pricing, and all of those things is accurate, and we're not having a bunch of unnecessary back and forth. We then have our landlords. Those really, when we talk about underwriting, have different perspectives on if the home is rented out on sites such as like Airbnb or VRBO, are handled differently than ones with like long-term tenants. So even the smallest detail of, again, the length, are they allowed to bring animals into the home? Are they allowed to have barbecue pits on the porch? You'd be shocked at how many insurance companies don't allow for fire pits close to the home just due to the fire exposure. And again, the actuarial data behind the amount of fires that occur in rental properties that have either, again, barbecue pits or potentially fire pits outside those locations. And then obviously the condition and maintenance history of the home all play into the eligibility, the pricing. And just a fun fact, a lot of times if the unit is more than 4 doors, so a four family or bigger, or for a family or smaller, it will go on a personal lines form. Anything larger than four families is tends to go through a commercial underwriting, which again has its own set of underwriting criteria and things that matter, which again in certain situations can be beneficial to your clients. They may not care as much about, updates to the home, but they may care more about, again, the fire pit or the barbecue pit. So again, depending on your client's rental portfolios, sometimes looking at underwriting or getting quotes with them from personal lines and commercial lines can make a lot of sense. And again, give them those options in the market that they're hoping for. And then we have our umbrella and high exposure underwriting. So this is where everything really connects. Carriers look at the client's total exposure, the assets, the drivers, where are things insured. I've seen, again, a lot of insurance companies may require that all vehicles and drivers and household be insured with the said company in order to qualify for the umbrella, or all assets. So maybe they have watercrafts and ATVs or UTVs, those all have to be with that company to qualify for the umbrella. But then there's red flags sometimes, such as claims frequency or aggressive dogs breeds that limit the umbrella underwriting. I have seen, unfortunately, where someone had a water or a boat accident. It was a very minor boat accident, but they didn't think through kind of the repercussions. And so what he thought was just a claim, and that's what insurance is for, ended up having a pretty big snowball effect because about 8 months later, when his umbrella came up for renewal, it was non renewed due to the boating accident, which then left him extremely exposed based on net worth. And the max he could get was $1 million in umbrella coverage, and his net worth was pretty above $10 million. So again, this is where underwriting does look at everything going on. They also look at the age of the client. So again, that boating accident that happens with the 50-year-old may have different underwriting implications than the boating accident that happens with the 75-year-old driver. So again, this is where, as the financial advisor, you can really help clients understand these potential red flags in underwriting, and again, maybe help them really connect with the right insurance professional to navigate at those times. Again, I actually just had an old client reach out who is elderly and had an auto accident. It was minor, but again, really helping them understand that you could file the claim with insurance, but if you financially can afford to pay it out of pocket, it's probably your best interest, because a lot of auto companies don't like, or they're not even eligible if drivers are over 75, let alone with an auto accident. And while the accident didn't include any other vehicles, it was still an accident on the record, which again potentially could have had additional implications just outside of the auto being non-renewed, potentially restrictions in the umbrella, maybe not totally non-renewed the umbrella, but again, dropping down what liability limits are available based on driving records. And then obviously ownership is another big red flag with umbrellas, because depending on who's in that LLC will determine how the umbrella responds. I have had underwriters, especially when there's like families that own a property or a few properties together within the name of an LLC or a trust. The umbrella company may not include that property within the umbrella coverage because of the structure of that. And again, they feel, based on their policy language, that if there was a loss, they would have to defend everyone within that trust or LLC. So again, how things are structured can also have implications on underwriting and if they're willing to offer quotes or not. And then there's obviously just the non-traditional or, more unique clients that you may work with that outgrow the standard carriers, which isn't always bad news. It just means that their financial portfolio and asset mix is unique. So this can mean that your clients now need high net worth carriers, maybe specialty markets for things like electric bikes or surplus lines to fill those gaps. These carriers tend to be more flexible and creative, but often do have higher premiums with less standardization and coverage. coverage. So this is again where the advisor can work closely with an experienced broker to ensure these policies are not only made available to your clients when necessary, but meet their needs based on, again, what they have going on, whether that's prior losses, maybe those higher end homes. I've had clients that have homes in multiple states, and based on where they own their homes, being in all high catastrophic areas, whether that was due to hurricane or wildfire, they didn't always have a market for the entire portfolio. So sometimes we were dividing that between different carriers based on, again, appetite and what the client wanted. And then we always have our surplus line. So this is really where it can get pretty much like the Wild West is the best way to explain it, because these are non-admitted carriers, so they're not backed by the government. If they become insolvent, they can really write the policies how they want. And what I mean by that is I've had some companies and the surplus lines exclude water damage completely because my client had three water claims in an 8-year period. So while I was able to get them homeowners coverage for things like fire or burglary or those sorts of items, any type of water damage, whether it was water backup, a pipe bursting, they had absolutely no coverage. So again, it still allows the client to transfer some risk, but potentially not all the risk. And that's where, again, you standing by the client's side to make sure they understand the limitations when they're in this market is extremely important, because not all insurance professionals go through this with your clients, and it can end up obviously being a big gap in planning that they end up turning to you for if the insurance does not cover it. So, how underwriting decisions affect coverage. Every factor obviously has a financial translation. Where and what underwriters see is end up what the client pays, which is obviously just risk and rate. So underwriters' job is really to balance acceptance, pricing, and terms to keep their portfolio profitable. So depending on the client's roof age can mean they have a limited market, which then means they're paying higher premiums. And roof age is something, it does not matter what state your clients live in. There might be five, or this isn't a true statement. A roof that is anywhere between 15 and 20 years old is going to be really hard for them to find placement. And when I say that age, I'm talking shingle roofs. If they have tile roofs, slate roofs, those have a little bit longer life longevity. But again, just understand that roof age is becoming a huge, not only eligibility, but pricing driver. I had a client who put on a new roof and saved over $900 a year, and I think they were paying close to about 3,400. So a nice chunk of savings. Again, the roof costs a decent amount too, but it did just kind of illustrate the impact that that older roof had on the pricing itself. And, for clients, a lot of times what they're seeing in rate feels like arbitrary. And you, as the advisor, being able to put logic behind it just helps them hopefully see insurance slightly different, and really allows them to not feel blindsided by, again, the price or coverage limitations as they go into the market. So, how pricing really works? Premiums are a combination of math and market appetite. So, base oh, the base rate is determined by loss experience. Is the home in a wildfire zone? Again, zip code is a huge indicator. I recently moved about 2 years ago from St. Louis City to St. Louis County. My auto dropped $1,000 a year by moving zip code. So again, zip codes and this base rate really have a big impact. So for clients that are moving, not only shop the home, but maybe do a quote on the auto to see if those zip codes have an impact. We then have, the modifiers like insurance score, their claims history. Do they have any risk mitigation devices like fire or burglar alarms? Then there's loss trends for that specific area. Things like cost of labor and lumber. And then finally, we have market appetite. And this is where, again, carriers kind of shrink their exposures in regions. They may raise pricing to slow down new business in certain areas. But um, Number four is where commercials don't always do a great job in letting clients know that, again, while there is an insurance company on every corner, your clients may not fit into that company's appetite. And appetite can, again, have a decent impact on the overall pricing from a client perspective. And so understanding that mix just really helps you explain things like rate hikes calmly and creditably to clients, knowing that, again, it's quite a few pieces that go into the rate that you're seeing on that declaration page. So when we talk about just how they come up with rate, there's also ways that underwriting identifies things like higher risk. Instead of just outright declining them, they think they're creative. And so they use things like higher deductibles to shift responsibility back to the client for those smaller claims. So this is where we saw and are still seeing a trend in the industry of wind hail deductibles being 1% or 2% in some states. Again, really kind of taking the responsibility of cosmetic damage that may happen to a roof and putting it back on the client, because the intent for insurance is really to, again, fix things that are truly broken and cause additional damage, such as, again, shingles being blown off due to a tornado, not because they have a few dents in them from hail. Obviously, if it changes the integrity of the roof, that's a different conversation. But just an example of where we've seen kind of deductibles specifically with wind and hail and roofs all kind of come into play. We then also see that they may have coverage limits. So they do this just to, again, kind of limit the exposure for themselves as the insurer. I see this all the time with water damage. So whether they're excluding water or offering a $10,000 water cap. We also see this a lot with animals, specifically like exotic animals or what they say aggressive breed dogs, where they may only offer 25,000 in liability, but then give you 500,000 in personal liability outside of that dog exposure. So again, this is where um, companies can limit what they see as large exposures and still be able to offer rates that they feel are competitive. And then there's always just the exclusions that kind of um, allow them to remove those exposures. A lot of times, these are things like flood, earth movement that can sometimes be purchased back through things like endorsements or standalone policies. But then there's exclusions that will always remain exclusions and you cannot purchase back. So, you know, from an advisor perspective, the financial planning question is really what level of loss can your clients absorb? And that's a perspective that's really going to transform the coverage decisions really into kind of more of that risk management instead of just I write a check every year to this insurance company. What is the value that I'm getting out of it? And then we have renewal notices. So depending on what state you sit in, you might be like, I get a renewal notice every year. I don't think anything of it. There's other states where you are extremely ecstatic to get the renewal notice, even if it's a 40% increase. But we have started to see non-renewals and rate increases come out of the blue for clients, or so they feel, but that's not usually the case. It might not be due to their own record, but broader market issues like we see in California with insurance markets actually pulling out of the market. So reallocation of where they feel they can write, and inflation pressure. So again, some insurance companies don't feel comfortable writing homes above $2 million. And so as the markets start to shift and those homes continually kind of find themselves in that replacement cost where the insurance company doesn't feel comfortable, they may start to send out non-renewal notices based on, again, that company appetite that we experience. So again, a lot of times clients feel like, and I'm in this boat as well in the past of like, why did my rate go up 15%? Nothing changed. Or maybe I did have an auto accident, but I wasn't expecting it to go up that much. There's more than just one or two factors that tend to be looked at when an insurance company is sending out renewal notices and or worst case non-renewal notices. In some states, being your clients being non-renewed is not an issue. Like in Missouri, on the application, we can't even ask clients if they've been non-renewed. In other states, it is an eligibility thing to where if you've been non-renewed from a company, you have to disclose to the marketplace as you shop that you have been non-renewed, which again can automatically disqualify you from specific companies. So this again can be a little bit of a scary situation depending on where you sit in the United States. So really, we're going to try and turn these underwriting challenges into planning opportunities because as you've seen, underwriting outcomes are not random. They are a product of complex data driven processes. So when you translate that process for clients, you not only strengthen their trust, but also reinforce your value as that strategic planner. And it's another layer of risk management that ties directly into your fiduciary role. So, again, whether it's pricing, the market shifts, having a better underwriting experience when they're engaging with the market, there's just a lot of, I'm going to say little things, but and that have big impact for your client's final experience. And then last 5 minutes, I will quickly go through this last few slides, but being able to collaborate with insurance professionals is where underwriting thrives on clarity and documentation. So when you provide that high quality, consistent information, like the proof of home updates or clear ownership details, you reduce the back and forth and you speed up approvals. Think of it like an underwriter, and you're sending an underwriter a ready to analyze file. The smoother you make their job, the better the client outcome. And not only that, but one of the biggest stress points for clients is timing. They often think insurance is instant, but underwriting, especially for large or complex risk, can take weeks. By setting those right expectations up front and explaining why a policy might come back with conditions or adjustments just reinforces your trust. Clients who understand the process are much less likely to panic when the premium changes. So again, your role as the advisor is not to be an agent. You're not selling, you are managing risk just like you do in the marketplace. And so integrating insurance, it isn't just a one-time transaction, it's part of ongoing risk strategy. You can embed underwriting awareness into your planning cadence, review coverages at the same time you're reviewing investment and estate documents, and over time this approach helps you prevent gaps and ensure clients proactively keep pace with their wealth. So, just a few quick takeaways to close this all out. Collaboration is the secret ingredient. When you build relationships with insurance professionals, you share complete information and maintain open communication. You not only make their jobs easier, you protect your clients' interests far more effectively. The more proactive the partnership, the less reactive the outcome. And again, it's things that you all are already doing and just really takes that black box out of not only underwriting, but insurance as a whole. And obviously, reaching financial security isn't about avoiding every bump, it's about having the right guide. And when your advisor understands PNC underwriting, every twist in the trail becomes just another part of a well planned and protected journey. So, Holistic Plan, we're here to turn everyday lifestyle details into underwriting ready insights. And I know we have about 3 minutes left. So, if there are questions, I will happily answer those and we will send them out with a recording of this webinar.
Great. Thank you so much, Megan. That was amazing. I believe we have time for one question.
Okay, perfect.
If not, we can definitely put it in the follow-up email. So I have one here that says, I was on a call the other day and the advisor said it was best not to have a college student drive your car at college due to the risk. Give them access to Lyft or Uber. In the long run, cheaper. What do you think?
Yeah, I don't think it's a bad idea. I mean, obviously, when kids take cars to college, you kind of, as a parent, lose control over who's driving that car, and what's always happening. So I think, again, it really depends on the client and the kid that's going away if it's the better move. But I'm not an attorney, but in my opinion, from a legality standpoint, the parent does seem to have less liability by their kids just using Uber versus them being the actual driver of the car with 3 or 4 people in the back seat, and then the car again hits a deer, they're still liable for that and those injuries that occurred from the guest in the vehicle. So, again, I do think it's a great way to potentially limit some liability if the child really isn't going to need the vehicle while they're away. And like I mentioned, if they're over 100 miles without a vehicle, most insurance companies give a pretty nice discount in those situations as well.
Great. We are actually nearly at time, but I just want to thank you so much, Megan. This was great. And just to recap for everyone that we will be sending out the slides and recording, so ensure you keep an eye out for that. And any questions that we didn't get to today, we will definitely send it over to Megan so she can answer that and send in the recap email as well. But thank you so much, everybody, for attending. And with that, we'll see you next time.